You've probably heard it 1,000 times. Debt is the enemy. Stay away from it. Pay off your credit cards. Live below your means. But here's the thing. Most people who follow that advice end up exactly where they started, scraping by month to month, never building real wealth. I know because I was there for 7 years, terrified of debt, avoiding loans like they were poison. It kept me stuck, watching opportunities pass me by, while my savings barely grew. The ultra-wealthy don't avoid debt. They weaponize it. They use other people's money, OPM, to buy assets that generate income, turning what scares you into their biggest accelerator. In this video, we'll break down why the scarcity mindset traps you in poverty, how to flip it with an anti-scarcity approach, and the safe steps to implement it yourself. We'll contrast how the poor use debt for liabilities that drain you, while the rich leverage it for assets that multiply. But first, let's unpack why traditional debt advice fails so many people. The scarcity mindset isn't just a bad habit. It's wired into our survival instincts. From an early age, we're taught that debt means failure. It's a moral failing, a sign you're irresponsible or worse, destined for ruin. Think about it. Your parents probably drilled into you to avoid borrowing at all costs, echoing the stories of bankruptcies and foreclosures that haunted their generation. This fear turns debt into a boogeyman, something to run from rather than understand. But in reality, this mindset keeps you playing small, focused on short-term security instead of long-term freedom. The common mistake here is using debt for liabilities, things that lose value and suck money out of your pocket. You charge a new car on your credit card at 20% interest, or finance a vacation that leaves you with nothing but memories and a bill. That shiny SUV depreciates the second you drive it off the lot, yet you're paying interest on it for years. Vacations, they're gone in a week, but the debt lingers, forcing you to work overtime just to cover the minimum payments. This isn't investing. It's slow financial suicide. You're essentially borrowing against your future earnings to fund fleeting pleasures or status symbols that provide zero return. Now, consider the real-world impact. This cycle locks the middle class into wage slavery. You earn a decent salary, but after taxes, rent, and those high-interest payments, what's left? Not enough to invest, not enough to build equity. You're trading hours for dollars in a job you might hate, all because debt feels too risky. Over time, inflation eats your savings, and you fall further behind. The average American household carries over $100,000 in debt, much of it consumer-driven, keeping them tethered to the grind. It's a trap. The more you fear debt, the more you rely on it poorly, perpetuating the scarcity. I lived this firsthand in my early career. Fresh out of college, I landed a solid job but shunned loans entirely. Friends were buying their first homes with mortgages, but I stuck to renting, convinced it was safer. That avoidance cost me big. Property values in my area doubled over those 7 years. I missed out on building equity while pouring money into someone else's asset. It wasn't until I hit rock bottom, staring at stagnant savings, that I realized my fear was the real barrier. If I'd borrowed smartly back then, even a modest property could have generated rental income to pay itself off. Contrast that with how the ultra-wealthy operate. They don't see debt as a burden or a moral issue. It's a neutral tool, like a hammer. Dangerous if misused, powerful if applied right. For them, debt is leverage, amplifying their capital without tying up their own funds. They borrow at low rates to acquire assets that produce cash flow exceeding the interest. It's not about being reckless, it's calculated. The key insight is that debt magnifies outcomes. When you use it for liabilities, it explodes your losses. Interest compounds against you. But for assets, it supercharges growth. A rental property financed with a 4% mortgage might yield 8% in rent after expenses, netting you 4% on someone else's money. Over decades, that compounds into millions. This scarcity view isn't just limiting, it's costing you generations of wealth. Break it, and you unlock the door to true financial mobility. Once you shift that perspective, the real power of other people's money starts to emerge, turning debt from your enemy into your ally. That shift begins with understanding OPM, other people's money. It's not some shady scheme. It's simply borrowing from banks, investors, or even credit lines at favorable terms to fund opportunities you couldn't afford outright with your own cash. The wealthy treat OPM like fuel for their engine, accelerating growth without depleting their reserves. Why does this work so well? Because when you use low-interest debt to acquire income-generating assets, the returns outpace the costs, creating a positive feedback loop. Imagine borrowing at 4% to invest in something that yields 8% or more. Your net gain is instant, and it scales as the asset appreciates. This isn't gambling. It's arithmetic that builds wealth over time. The stakes are high. Without OPM, you're limited to your salary's pace, staying in the slow lane while others zoom ahead. Master this, and you free up your own money for higher risk, higher reward plays, compounding your net worth exponentially. At its core, OPM flips the script on scarcity by focusing on assets that pay you back. Assets are things like rental properties, dividend stocks, or business ventures that generate cash flow. Rental income covers the mortgage, and then some. Stocks pay dividends. A side business brings in profits. Liabilities, on the other hand, are the traps we discussed. Cars, gadgets, clothes that depreciate and require ongoing expense. The what here is straightforward. Identify opportunities where the asset's return exceeds the debt's cost. Start by evaluating potential investments. Does it produce ongoing revenue? Can it appreciate in value? Connect this to what you know. If you've ever saved for a down payment the hard way, realize OPM lets you skip years of scrimping by leveraging credit wisely. Here's how to put it into practice. First, scout assets that align with your risk tolerance. Real estate is a classic, like buying a multi-unit property where tenants foot the bill. Borrow via a mortgage at current rates, say 5-7%, and aim for rents that cover 120% of expenses for a buffer. Or consider business loans for equipment that boosts production, turning a $50,000 loan into $100,000 annual revenue. A real example. One client I advised borrowed $200,000 at 4.5% to buy a duplex. Rents brought in $2,500 monthly, netting $1,000 after costs. That's 6% return on borrowed money, plus equity buildup. Avoid the pitfall of over-leveraging. Always maintain 3 to 6 months of cash reserves to weather vacancies or market dips. Don't chase shiny objects. Vet deals thoroughly, using tools like cap rates for real estate to ensure profitability. This approach isn't theoretical. It transformed my own portfolio. For years, I hoarded cash, earning peanuts in a savings account, while inflation eroded it. Once I embraced OPM, I financed my first investment property with a small loan. That single move kicked off compounding. Rents paid down the debt, and appreciation doubled my equity in 5 years. Suddenly, passive income covered my basics, freeing me to scale. You can do the same. Start by listing 3 assets in your local market. Run the numbers on borrowing costs versus projected yields. It's empowering. Debt stops being a chain and becomes a launchpad. The urgency here is real. Markets move fast, and delaying means missing the cycle. This anti-scarcity mindset doesn't just build wealth. It rewires your brain to see abundance everywhere, turning fear into fuel for freedom. But theory only gets you so far. To make this stick without self-sabotage, remember the principle: debt serves the asset, never the other way around. If a deal doesn't cash flow positively from day one, walk away. That's the discipline that separates dreamers from doers. Now that you've got the mindset, let's get practical with safe steps to implement this without unnecessary risks. Start small to build confidence. Assess your current finances first. Pull your credit report. Calculate your debt-to-income ratio, and ensure it's under 36% to qualify for favorable loans. Why begin here? Rushing in without a solid base leads to denials or high rates, amplifying scarcity fears. The benefit is clarity. Knowing your numbers empowers you to borrow at the best terms, turning potential stress into strategic advantages. What this looks like is a simple audit. List all income sources, fixed expenses, and existing debts. Tools like free credit apps Make it easy. Aim for a net worth snapshot to spot leverage opportunities. The first tactic: use home equity if you own property. It's often the lowest risk entry. If you've built some equity, tap it via a HELOC at rates around 7–9%, far better than credit cards. Direct that toward diversified assets like index funds or a starter rental. For instance, extract $50,000 from your home to fund a down payment on a property elsewhere. The how: apply through your bank, but shop rates. Compare at least 3 lenders. Common mistake: treating it like free money. Always project cash flows to confirm the new asset covers payments plus a margin. I did this early on using equity from my first home to buy a condo. It generated $800 monthly surplus, paying itself off in 8 years while values rose 40%. Once stable, scale up by refinancing assets to pull out equity for more deals. Say your rental's value climbs. Refi at lower rates to extract cash tax-free, then reinvest. This creates a snowball. One property funds the next. Building a portfolio without fresh capital. Why it matters: it accelerates independence, potentially hitting financial freedom in a decade instead of 3. The what is cyclical: refinance every 2–3 years if rates drop or values increase, but cap leverage at 70% loan to value to avoid overexposure. In practice, work with a financial advisor for the math. For my second property, refinancing freed $30,000 that bought stocks yielding 7% dividends. Diversifying beyond real estate. Don't overlook tax advantages. That's a common error costing thousands. Good debt on assets often qualifies for deductions,